Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Let's stick with tech. McKinsey estimating that data centers will require $6.7 trillion to meet demand for computing power globally by 2030. Private credit firms are laying the groundwork to help provide the capital. Meta is said to have selected PIMCO to help lead a $29 billion financing for its data center expansion. I'm happy to say the PIMCO CEO, Manny Roman, joins us now for more. Manny, good morning.
Good morning, Jonathan. Nice to see you.
It's good to see you, sir. How does a man like you deal with a 3 a.m. alarm clock on the West Coast? How does that work? You've got outliers.
I make the best espresso known to mankind, and you'll be happy.
Triple espresso?
Triple espresso. And it feels good every day and happy to be at work.
Well, I'm happy to have you with us this morning. Let's get into some of these deals. I know there's certain deals you can talk about, can't talk about. I want to talk in broad terms about the appetite here. For the capital that we need to provide to this particular force, this growing force, AI data centers, where it's going to come from, and where you and the team are going to fit in.
So I think it's a huge, super secular opportunity. There is an enormous need for funding and equity in data center. I don't know whether the $6.7 trillion from McKinsey is remotely right, but it's very, very big, and there'll be plenty of financing deals to be done, and there'll be plenty of construction to be done, and it's true in the US, but it's true in other parts of the world. And the need also to have the infrastructure and the energy will come after that. So, we all talk about data center, but there's going to be a real rush for energy in terms of providing the right setup for all this data center. And, that's one of the reasons to be very bullish on natural gas.
We've reflected on one particular statement from one particular tech CEO over the last 12 months that I think was really quite important. It was last summer. It was the Alphabet CEO, when essentially he said that the greatest risk here was underinvesting and not overinvesting. And I wonder how you think about that from the perspective as an asset manager, when you've got a group of companies that are willing to run the risk of overinvesting. How do you think about the risk around it?
In terms of, I think what we will do is we will look at every single deal and we will say this makes sense for us and this may make less sense. And I think one of the strengths we have is to be pretty focused on relative value and sort of think that there may be a fantastic deal to be done, which would be very, very good for our investors. And then we'll look at the next one in the full light of day and decide whether it fits our portfolio and whether this is something we want to do.
I think it's important to build on this, that Mark Rowan said recently, we are what we originate. When it comes to private markets, you are what you originate. It's quite labor intensive. It takes a lot of work. When you think about scaling this and building this as an opportunity, how difficult is it in practice?
I think we have built it differently from Mark. We have built it based on our experience in fixed income, our experience in relative value, in a history of 54 years, in looking at all sorts of credit. We have 55 credit analysts who looks at every single segment of the market. And I think we look at it from a value standpoint. Does it make sense? Is it something we want to do? We shouldn't be originating for the sake of originating. And there's a lot of money coming to this market. Some sectors will be very attractive and some will be less so. And I think you want to be very much on top of this and say, I want to do this and I want to do less of this.
There's a concern, especially as CEOs say, it's more important to be throwing enough money at this rather than being underinvested. And then you have people like David Heinhorn of Greenlight coming out and saying the numbers that are being thrown around are so extreme that it's really, really hard to understand them. How difficult is it to invest in a market where people are throwing spaghetti at the wall to try to understand what's going to stick, and there is a feeling of excess that continues to bubble up around this?
So my friend Richard Thaler, who is an economic Nobel Prize and consult for us, has this say. He says, when you make long-term prediction, the degree of humidity and the standard deviation around the estimate should be very, very big. So when I hear an estimate like $6.7 trillion, I don't know what to make of it. David may be right, but we'll take it one step at a time. I think 6 months horizon is about all we can do in terms of the demand. And then, the environment may change dramatically. There are business cycles. Sometimes things are cheap. Sometimes they're expensive. If there's a recession, all of a sudden spreads will widen, company may revisit what they're trying to do, and so on and so forth.
So this is the difficulty. How do you have a 6-month horizon when a lot of these investments are 10-year build-outs, when they're 10-year usage, when they are labor-intensive, and infrastructure projects by nature are a lot longer than 6 months?
So in terms of committing capital and in terms of finding the right opportunity with the right length of time, we're totally fine to have a very long-term horizon. What I'm saying is making long-term prediction in terms of how big the market will be, it's very hard. I think you have some visibility over the next 6 months in terms of what the demand is, what the real demand is, and whether that slows down or whether that accelerates. You just don't know. And I think you have to be very humble about these things and just say, look, we'll take it one step at a time and see what the market gives us. And by the way, there may be other opportunities which are more attractive. You look, for example, in our asset-backed finance business, aircraft leasing. Aircraft leasing is incredibly interesting, and then nothing happens for 5 years, and then it becomes very interesting again. And you gotta constantly say to yourself, are there better opportunities for me to deploy money? And what do I want to do? How do I think about the risk? How will I get out? What's the right risk-return profile?
You made a headline recently. Wanted to ask you about it. Private markets haven't been tested. Can you build that out a little bit more? What did you mean when you said that private markets haven't been tested?
Well, my partner, Diane Iverson, and our CIO of Core, Mohit Mittal, have the chart. And we checked the number about 20 times because we kind of didn't believe it. But it shows the return on weak single B, which is a reasonably good proxy for direct lending. And what you see is you make money because the yield is higher, and then there's a recession, and then you lose it all. And so I'm old enough to remember 1991. I saw that. There's a recession which came out of nowhere from, essentially SNL having too much high yield. 1997. The world is absolutely fine until there's an Asian crisis, and then you have LTCM, and then things become very cheap. And so you got to remember these things. And we have been in a period since 2009 of exceptionalism, where you have had very strong equity return and very strong high yield return. If you believe this is gonna continue for the next 15 years, then I think you should have the same position. But it may not be the case. And I think we bring that and say the data's at the data.
Do you see parallels between now and those periods?
Well, I think the initial condition where we are right now are such that equity markets are expensive by any measure. They may go higher because momentum is strong, and credit market are tight in some part of the spectrum. And I think that's the reality. And look, we've been in a period where things are expensive for a long time. 2005, 2006 were such period where things remain expensive and became more expensive, and then something breaks, and then all of a sudden you have a lot of work to be done.
Manny, let's continue the conversation we were having. Equity markets very close to all-time highs, credit spreads near multi-decade tights on investment grade, high yield spreads near the tights of the year. And yet we've got a Fed official saying that we're excessively restrictive. You're across a range of funds. You look across markets all the time and the economy with the team. Do you see any signs that we're excessively restrictive?
Well, I think rates are very high across the globe, right? And I think part of the reason why I get up so early and happy to go to work is because the opportunity has never been better. And we talk here about the US, but look at the UK. The UK, where you're from, is 10-year rates are 4 3/4. Australia looks really, really attractive. So when we think about the opportunity in a way, yes, we do expect the Fed to cut. How much they're going to cut next year remains to be proven. No one knows what's going to happen to the labor market, but the reality is the opportunity in terms of global fixed income is very, very big, and the opportunity to add alpha is quite high. I'll tell you a funny story. We have a partner in Tokyo called Tomoya Masano, and for the longest time there's not much happening in Tokyo. So you sort of call him and you have matcha with him, and not much is happening. And then all of a sudden the Japanese fixed income market becomes super exciting, and then there's a lot to do. And there's a whole generation of people who have disappeared because they don't do it anymore. And so you have a labor market which hasn't supplied fixed income investor because there was nothing to do for the longest time. And so what I think is interesting is the difference of view, the difference of opinion is also a source of incredible alpha. And, if you want to think about why performance has been quite good, it's partially because the alpha that is being given by the market is quite good.
I think it's interesting that John was talking about the Fed and you talk about the international sphere. And I think that that's really telling about what people are looking to for that alpha, for that incremental extra yield. Are those Japanese investors staying in Japan right now and not coming to the U.S. for treasuries, even if the Fed cuts?
No, I think they're very big investors in U.S. assets. And remember, one of the opportunity everyone has is to buy foreign assets and swap them back into dollars or swap them back into yen and so on and so forth. And so you can actually buy synthetic credit, you can buy synthetic dollar exposure for U.S. investors buying, for example, JGB and selling forward the yen into dollar and having a different credit risk with JGB than you have with US dollar. And so there's a lot to do. Now, we do that a lot in short term and longer term in terms of adding alpha, but all the time you can do this sort of transaction and sort of mitigate your exposure or increase your exposure or have different risk profile.
That's a much smarter way of looking at it. I'm looking at this with sort of a blunt instrument, sort of dumb. Do you like international more than the United States?
But I mean,
and you come up with this really wonderful, nuanced view.
Japan has an enormous amount of money to put to work and is a nation of savers. And so the thing that I always say is you need to put your money somewhere. And the reality is the US is the only place where you can actually put scale. And when you want to think, for example, of the Australian problem, there was a whole delegation last week from the UN from Australia. They need to move capital away from Australia because they are a nation of savers and the Australian market is not big enough for them, and so they need to pivot too.
For a long time, Japan had to do the same thing. They didn't have the yield. To your point, the story's changed. One thing we're trying to track is whether the Japanese bring the money home, whether we see this great repatriation where it could leave markets vulnerable, where typically they deploy that capital. I'm thinking of certain European markets, the US as well. Are you seeing any of that flow story start to turn?
No, not so far.
Would you expect it to change?
Honestly, not really. These things are very, very slow to move. And the reality is people keep on saving in Japan. And so it may just be that the marginal dollar goes into JGB, but the credit markets are very underdeveloped. And if you want to buy, for example, single A exposure, you're much better off going to the US.
The conversation we had back in April was maybe the decline of US exceptionalism. The money was going to leave, it was going to go elsewhere. I want to understand where you are now 6 months later. What did you see at the time in April? Did we start to see that decay click into US exceptionalism? And are we back to where we were at the start of the year just 6 months later?
So I think we were dollar underweighted. We literally just square off our position. We still very much like emerging market currency. We do like Australian dollars. There's plenty to do, but there was a short dollar position to be had. And, it moved 10%, and I think we decided to square our position.
You're talking a lot about rates and the era of income. We've been talking a lot about that just based on the fact that yield has been higher. We're talking about private investments through infrastructure. You're not mentioning equities. And this is a time when people are talking about...
I'm a fixed income guy.
No, I know, and where you have sympathy with us. But I'm wondering how much a higher rate regime limits future equity returns. We used to talk about that. That was before 3 years consecutive 20+% returns. I mean, at what point will it constrain the equity side of the portfolio, even though some people are wondering what kind of buffer bonds really provide?
Well, the PIMCO view is that equity return in the US is going to be 6% for the next 3 years or something like this. I mean, we look at CAPE valuation, it's trading at 28 times earnings. It looks really, really high to us. We understand the excitement about the hyperscaler. But if you look outside of the hyperscaler, life in industrial America isn't great. I mean, top line is not growing. And one of the questions that we don't know is the impact of tariff and what will happen in corporate America in terms of how they're going to deal with either passing on prices or diminishing margin and so on and so forth. And we don't know that. And so there's a whole leg of the equation that we haven't really seen.
Stock investors have been trying to outbull each other this morning, and Max Kettner was on earlier of HSBC, and he was saying, look, he thinks that the Fed is making a policy error by cutting more significantly, but they're along for the ride because it's just going to inflate the prices of assets significantly. They want to gain from that. Do you agree with that assessment?
Well, I haven't listened to him, so I would not be.
Good initial punt. I mean, do you think? Yeah.
I don't know. We have a lot of trust in the Fed in terms of them doing the right thing, and I think that the Fed usually doesn't know much more than we all do. They look at the same data, and so the decision is a very well thought out decision where they will decide what to do with the condition that they are being given. And if, for example, we were to see a very bad inflation print, it would be very difficult for them to cut. Now, they may argue that they have to look through inflation and so on and so forth, but the Fed is a very rational actor in the market, and I don't think anything's going to change. And the same goes for the central bank in the UK and the ECB and so on and so forth. And I think once you're in a job, your behavior changes also in terms of how you think about what the right thing to do is.
Are you alluding to the new Fed chair next year?
No,
when you say
I'm just saying it's like being a Supreme Court justice. You know, it's a very important job, and I think people take their job very seriously.
There could be a big change next year. There's going to be a new Fed chair. Do you expect to see any daylight between a Fed chair appointed by this White House and Chairman Jay Powell and his current leadership?
You know, I was reflecting on this and we were talking about this. I mean, every single Fed chair has been, to some degree, a political appointee. And, there's been a history of very good Fed chair since the Burns and the Nixon presidency. And I see no reason why that would change.
The list of candidates we've seen so far, we've said it repeatedly, very credible names on that list from this White House and the Treasury.
Yeah. And it is important to remember that it's in everyone's incentive to have a very credible Fed chair, because the market will not like a non-credible Fed chair.
Stay with us. More Bloomberg surveillance coming up after this. Top congressional leaders on both sides will be meeting with President Donald Trump at the White House to discuss a short-term spending bill in an effort to avoid a government shutdown. With the latest and with a special guest, Anne-Marie joins us now for more. Hey, Anne-Marie.
Hey, John, good morning. We are looking like we are headed towards a government shutdown, even though the President of the United States will be sitting down in a bipartisan fashion with the top leaders from the House and the Senate. An individual who has been part of these conversations in the past, because we have been here before, is Patrick McHenry, former chair of the House Financial Services Committee. Former chairman, thank you so much for joining us this morning. Just going into this meeting this afternoon at the White House, do you think there is a chance of a breakthrough and this Congress can avoid a shutdown?
No, I don't have high hopes for this. I think it's unrealistic to think that the incentives will change by simply sitting down with President Trump. The incentive here right now is for congressional Democrats to find a way to fight. That is purely it. This is a mechanism for them to say that we are relevant. They're only relevant because they have the filibuster in the Senate, and Republicans do not have a filibuster-proof majority in the Senate. The continuing resolution, which is merely to keep the lights on in government for the next 6 weeks, passed the House. It now sits in the Senate. And the minority party in the Senate, the Democrats, have the say on whether or not the bill can be brought up, and they have blocked it last week. They are likely to block it this week. They need to show their base that they're fighting, and this is their way of doing it.
Could this have any pushback when it comes to the midterms on Republicans, given recent polling shows that when it comes to health care policy, which is the crux of the Democratic issue right now, when it comes to this extension of the government funding, that they actually get favorable numbers?
They do, but the rest of the issue set favors Republicans, from the economy to law enforcement to immigration. The field is tilted for Republicans on the policy front. The one silver lining for Democrats is health care, and this is what they want to highlight in the shutdown. The odd thing about a shutdown, and this shutdown that we're looking at right now has a lot of similarities to May of the 2013 shutdown, where congressional Republicans, I was part of the group. This is why it hurts me to see what Democrats are doing right now. We said we wanted President Obama to repeal his signature healthcare initiative, Obamacare. Very popular. Our stance was very popular with the American people. And in shutting down the government, we got nowhere on the policy. We got nowhere on furthering the belief that American people thought the Republicans were right. I think this is what we're going to face with Democratic leaders in the Senate and in the House. They're going to recognize this fight is not worth fighting. And in fact, a shutdown is in fact and continues to be a very dumb political lever here in Washington.
Well, in 2013, when they finally came to an agreement, there was a little bit of concessions when it came to the Affordable Care Act. Could we see concessions from Republicans and Democrats this time around to keep the government open?
Well, I think it's highly unlikely on the short-term government funding. On the longer-term one, which will take time to put together, I think you can see some modifications. And there's a lot of wiggle room when you're funding a nearly $2 trillion government. And so I think there is an opportunity there. But for them to actually, for congressional Democrats to go into a shutdown strategy, this is their first time of trying this. What they're going to find is that this is not it does not give them what they think it will get them. I think they're going to have to wait for further policy on a longer term spending bill, and they pulled this trigger at the wrong time.
How serious do you think the OMB is about when it comes to furloughs that usually happen during government shutdowns to actually making those job cuts permanent?
No, I think this is a plan the OMB director, Russ Vought, has been stewing for a long, long time. He's thought about this and thought about this and thought about it. And the White House strategy rests on OMB. OMB has enormous powers to carry out, especially in a shutdown, enormous powers over the executive branch and the functioning of the executive branch. And Russ Vought, the OMB director, has a plan. And I think it's going to be a very devastating one for Democrats. And they're going to rue the day that they actually gave Russ Vought this enhanced power. It's going to be fascinating to see what happens in the next week into the shutdown and for the weeks ahead, frankly.
A key question for financial markets as the shutdown looms is whether or not we're actually going to get economic data. We're supposed to get the non-farm payrolls report on Friday. If we're in a shutdown, will we get that report?
It's unlikely. It's unlikely we'll get that report. But this is also up to OMB. This is one of the things on whether or not it's deemed essential, the funding streams, or it's a complicated set of laws that OMB has the wide authority to implement. That's one that's an open question, frankly. But also our governmental statistics are an open question by the markets anyway. There's a lot of questioning of these statistics and the validity of them. And so, I think OMB may take the broader authorities than in previous shutdowns.
Stay with us. More Bloomberg surveillance coming up after this. Stocks inching higher as investors continue to navigate the AI boom. Max Kettner of HSBC saying things are looking up, writing the broad-based asset price inflation is continuing full throttle, and we think there's more to come. Max joins us now for more. Max, good morning.
Good morning.
See you. We were talking about your note you published earlier this morning, so I think we should probably start there. So here's the line. We still see clear signs of US and global growth re-accelerating in contrast to downbeat consensus expectations. Lisa, straight away, bang. What's downbeat about consensus expectations into next year?
Look, I think when we look at both earnings expectations and top-down GDP expectations, they are still pretty downbeat. Certainly not where GDP now is, where all the high-frequency data are, both top-down and bottom-up. If you look at bottom-up, actually, when we strip out tech, earnings expectations Q3 versus Q2 are pretty much flat. So we're going into Q3 earnings season in a couple of weeks where, for most sectors, actually consensus is saying earnings are either going to be flat or down quarter over quarter sequentially. In a quarter where probably growth has been really, really robust from a top-down perspective. That doesn't make sense. If you look at Q4, even GDP, what we're seeing is it's barely 1% quarter-over-quarter annualized growth expected. Again, what we are not only seeing at the headline number, that 1%, which is a 0.25% annualized, but when we look at the contributions to that, consensus is still saying there won't be any comeback of investment. And that doesn't make sense to me. You can't say we've got a little bit less political uncertainty. We kind of know how to deal with this environment now. We've got the big, beautiful bill coming through. We've got wealth gains coming through. We've obviously got, these AI capex story coming through. But at the same time, consensus is saying, nope. All this tariff story, it's going to continue weighing on investment in particular. And that's really big upside surprise potential.
I think the reason why both John and I were a little bit confused by this idea of consensus is because in the past couple of days, Brian Belsky saying 7,000 for next year, not necessarily high enough. Christian Muller-Glissman over at Goldman Sachs upgrading their forecasts, and Goldman Sachs keeps upgrading to the markets repeatedly. John Stoltzfus, the biggest bull on Wall Street, you see others just coming out of the woodwork talking about 7,700 on the S&P for next year. How can you say that's a bearish outlook or not bullish enough?
Yeah, look, actually, what we are seeing now, that sort of streak of upgrades, that's the most bullish thing that you can imagine. Because we run a series called Consensus GDP Forecast Diffusion Index, where we actually look at the data that you guys produce, so all those consensus expectations around GDP. Once that shoots higher, so once you really see upgrades across the board for the major global economies, so for the likes of the US, Canada, China, Eurozone, and so on, that is really, really bullish, right? Particularly for cyclicality, particularly not only for adding for equities and not just, okay, it's a monetary driven story, it's probably tech outperforming, but really for cyclicals to outperform. Now, on the other hand, let's not just focus on the expectations and on people upgrading their, the year ahead forecasts, but also about the market action. When we look at the market action year to date, and you look within the S&P, cyclicals are up pretty much the same as defensives. So it's not like cyclicals are up 20% and defensives are like 5%. And you're like, wow, this is all baked into price action already. No, both are up, give or take 9%. So it's not like actually price action is telling us, wow, there's so much hope into cyclicals baked in.
Not to be a negative Nelly, but you could argue, hold on a second, not always. I'm just contrarian Courtney. Look, honestly, we're looking forward and we're talking tonight. Please, bear with me. Honestly, you could say if things were looking so good, why is the Fed cutting rates?
That makes it even more bullish, if we're honest.
Right, sure, but why should they cut rates?
They shouldn't. I mean, don't ask a German why they should cut rates, right? The German will always say they shouldn't be cutting rates. No, I mean, look, I guess the point is to bring it back to slightly more, serious topics. If we look at what the Fed can do, can they cut another 1 or 2 times? Sure, fine. Should they necessarily, with uber loose and easy financial conditions? Probably not. With 3-ish inflation, should they really be cutting a lot? Probably not. But at the same time, what we undeniably have is we have weakness in the economy. It's very different. The economy is on 2 very different paths. Let's be honest. If we weren't market people, if we were people working in the labor department, we'd be talking about the economy very, very differently. There is absolute strains on the weaker part of the economy. We're talking about the Russell 2000, John. You were talking about the Russell 2000. Let's go one step down. Let's go to the smallest caps that aren't actually listed. There is very clear strain. They can't get funding. You look at credit card delinquencies, auto loan delinquencies. Look at real wage growth, the highest wage growth percentiles versus the lowest ones. The lowest ones are already going to around 0% real wage growth. Tariffs, of course, are eating into the lower end consumer goods, into things like food and beverages that already have outstripped cumulatively inflation since COVID. Now you add on tariffs. It's a clear strain on the weaker part of the economy, and they need the rate cuts. What that, of course, for us means it's even better for asset price inflation, because you've got a re-accelerating economy, and now you throw on rate cuts, which normally never happens.
That story you described doesn't make you bearish. In fact, it makes you incrementally more bullish, because they're going to have to respond to it. What would make you bearish is what Lisa is trying to ask here.
Yeah, I think, look, it is very clear. Anything around, let's say, Supreme Court or government shutdown, that's like, can we get like 1 or 2 or 3% down? Sure, right? A handful of percent down. But at the end of the day, this is just buy the dip opportunities. The reality is, if we get a return to 2022 where the Fed says, oh, shoot, we are very wrong. This is like 2022. This is transitory. If we say, oh, you know what? This is not just 3%. This is entrenched 3%. And 3% seems to be the low now. And now we're re-accelerating even inflation. We're not even done cutting. We're not even stopping. We're actually, the next move is a hike. Once we get that puts a stop to it. How far are we away from that? Minimum 2 quarters. Last week I still had conversations about, they're going to do 50 in October. We're minimum 2 quarters away from that, because let's remember, we have had this re-acceleration in the data that, not a lot of people were talking about a month and a half, 2 months ago. Now it's sort of creeping into people really and saying, hey, look, the US seems to be doing better from an aggregate growth perspective, but what we really need for a proper hawkish shift is actually a re-acceleration in the labor market. And given that supply story, given that really low break-even number, it's almost impossible to get that in the next couple of months. Right? So that makes it sounds intuitively completely wrong, but it's the best of both worlds. You get a sort of weak-ish labor market, but you've got re-accelerating activity data, which means good earnings, but sort of sluggish consensus expectations, low bar to beat, but at the same time rate cuts into a re-acceleration, which, Lisa, to your point, is that a policy mistake? I think so. But of course, that's probably a story we're going to play in 2026, not the next 6 months.
Stay with us. More Bloomberg surveillance coming up after this. Traders looking ahead to payrolls data due out on Friday after stronger than expected economic data. Jim Bianco of Bianco Research writing the Fed should not continue to cut rates. The economy is doing much better than the consensus. Jim joins us now for more. Jim, welcome to the program, sir. I want your perspective first on the recent Fed debate, the division that we're seeing from the Fed speak of the last week or so. Where do you land on things, Jim?
I think some of that is political. I think some of the Federal Reserve officials are running to try and replace Jay Powell. And I might respectfully say that the quote you had from Jim Bullard is in that camp, too, because it was very inconsistent what he said. And I think some of it is genuine, that there is some that are looking at the economy kind of like I do. And that is that it's doing okay, if not better. The Atlanta Fed GDP number is now nearly 4%. It's higher than every single estimate on Wall Street right now. And the inflation data is staying sticky. And the goods part of data, which would be tariffs, is really starting to show signs that it's moving higher. So for those that say, where's the tariff inflation? It's right there. It's coming. It's underway in the CPI goods category.
Jim, how credible do you think this pursuit of 2% is? It's something that dominated our conversation on decision day. Is this credible?
It's got a problem. And the reason it's got a problem is if you look at the inflation expectations data, I'm talking about like the inflation swaps or the CPI break-even rates, or the TIPS, break-even rates, they're all above 2.5% out till 2030. Well, I know, one of the best questions I heard during the press conference was from Mike McKee, where he pointed out that the Fed said, we'll be at our target in 2 years. And he pointed out the last 11 years, you've said you'll be at your target in 2 years, and you've yet to be at your target in 2 years for 11 straight years, and now you're going to try for a 12th year. And the market is saying you're not going to be at your target for 5 more years, because out to 2030, it's still got, elevated inflation. Not runaway, but definitely not getting anywhere near 2%. And the Fed needs to address that. And they're really not at this point.
At the same time, Jim, can't you say that tacitly, if they're accepting 2.4%, which is currently what break-even rates are pointing out for the next 10 years, is the likely inflation rate? If that is the inflation rate, isn't this market and isn't this Fed saying that's fine, as long as we don't torpedo the labor market, as long as we keep the economy chugging? Where's the problem?
The problem comes in where's the neutral rate. If you're going to accept 2.5% or so as the inflation rate with R-star, that's 3.5%. If you're going to, that would be a 1% premium above that. If you're going to accept 2.5% as inflation, maybe R-star should be a little bit bigger. In other words, you're no longer moderately, you're easy in the market. You're probably at neutral. And if you cut 1 or 2 more times this year, you're going to be too easy in the market, and you're going to risk fostering more inflation. So it really comes down to, do you want to cut rates 2 more times? If you do, then you shouldn't be tacitly accepting 2.5% as the inflation rate, long-term inflation rate, because you should be done cutting rates then at this point.
Do you get comfort, Jim, from the fact that after the Fed cut rates, you aren't seeing a steepening in the yield curve? You aren't seeing a runaway at the long end of the yield curve like what we saw last year, that people are seeing there as justification economically for the Fed to be more aggressive?
Yeah, at least at this point, but I fear that we're in a holding pattern waiting for more data. And I also fear we're not going to get that data because we're going to have a government shutdown on Wednesday at midnight. And I'm talking about like the payroll report on Friday, and next week, the CPI report. Remember that the last government shutdown under Trump in 2018, 2019 lasted 35 days. And the Fed is effectively going to go into the October 29th meeting with no more government data, which is what they rely on. Jay Powell called it the gold standard, than they have today. And they'll just assume that everything is as they understand it today, and they'll cut rates. And what I'm afraid of is when we get that data, whenever we get that data, it's going to show a meaningful uptick in the economy.
Jim, I want to build on that. We've been talking about this reacceleration now for a while. Markets priced for it into 26. Lisa mentioned Neil Dutta early this morning. This is what he said on the jobs market. If firms expect growth to perk up, it's curious they haven't ramped up hiring an hours already, Jim. What do you say back to that?
You know, I think the issue with the labor market is really the break-even rate right now. We need to start ask the other side of the question, which nobody wants to touch. Okay, we've created 29,000 jobs over the last 3 months. How many should we be creating? And Jay Powell answered that towards the end of his press conference. He said maybe 0 to 50,000. Midpoint of that's 25,000. We've created 29,000. I understand this is a number that we're not used to. To say 29,000 jobs over 3 months is just fine. That's all we need in this economy. But we've got the lowest population growth in almost 100 years because of the closing of the border and increased deportations. And if that's the case, if you have no population growth, you don't need to create that many jobs. So really, this is the crux of the labor market issue. It's not how many manufacturing jobs versus service jobs versus healthcare jobs did we create last month. The fundamental question is, how many do we need? And the answer might be not that many, given low population growth.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.